Everybody on financial TV keeps repeating the same old script. Diversify, stack bonds, hold cash, trust the system like it's unbreakable. And yeah, for most of the last century, that playbook actually worked, so people got comfortable and stopped questioning it. But here's the number nobody wants to say out loud: 97%. That's how much purchasing power the dollar has lost since 1913, not in one big crash, but slowly, quietly. Like a leak you don't notice until the floor is flooded. And right now in 2026, something deeper is shifting under the surface, something structural, not just another cycle. BRICS nations are trading without the dollar more than ever. Central banks are stacking gold like it's going out of style, and the global game is changing whether people admit it or not. The dollar isn't dead, not even close, but the pressure is building, and when that pressure hits, it doesn't hit everything equally. It hits specific assets first, and hard. The crazy part is, most people already own these assets thinking they're safe, thinking they're playing it smart. These are the same assets financial advisors have been recommending for decades, the same ones that built generational wealth in the past. But what worked in the old system can absolutely wreck you in a new one, and that's the part nobody prepares you for. Let's start with the first one. Long-duration U.S. Treasury bonds, the so-called safest investment on earth. For decades, these things were treated like a financial religion, something you just don't question, something institutions built their entire portfolios around. But the truth is, safety in finance is always conditional, and when the system changes, safe can turn into slow bleed real quick. History already ran this exact script, and people ignored it because it didn't happen in their lifetime. Back in the 1940s, the British pound was seen the same way the dollar is seen today: dominant, stable, untouchable. Investors loaded up on government bonds, thinking they were locking in security. But over time, inflation quietly ate away their purchasing power until what they got back was worth way less than what they put in. This is where it gets sneaky, because nothing breaks on the surface. You still get your interest payments, your principal comes back on time, everything looks clean on paper. But in reality, what you're holding is losing value year after year, and by the time you notice, the damage is already done. There's actually a name for this move. It's called financial repression. And it's not some conspiracy theory, it's a well-documented strategy. When a government has too much debt, like way too much, it doesn't default because that would be obvious and chaotic. Instead, it keeps interest rates lower than inflation, so over time the real value of that debt just melts away. The wild part is the United States already did this before, and it worked exactly as intended. After World War II, debt was massive, so instead of paying it off the hard way, they capped interest rates while inflation ran higher. Bondholders technically got paid, but in real terms they lost purchasing power every single year. Fast forward to today, and the setup looks eerily similar, just on a much bigger scale. US debt has exploded past $36 trillion and is still climbing like there's no ceiling. Interest payments alone are becoming one of the biggest expenses in the entire federal budget, which is honestly insane when you think about it. Here's where the math gets ugly real quick. If interest rates were raised high enough to truly fight inflation, the cost of servicing that debt would skyrocket to levels the system literally can't handle. So the government is stuck in a corner where the only realistic move is to let inflation do the heavy lifting again. And if you're holding a 30-year Treasury bond right now, you're basically locking yourself into that system. On paper, the yield might look decent, maybe even attractive compared to the past decade, but if inflation averages even 4 or 5%, which is honestly a conservative guess, your real return is negative, no matter how you slice it. That means you're not preserving wealth. You're slowly losing it while feeling like you're doing the safe thing. It's like being on a treadmill that's slightly tilted downward. You don't notice it at first, but over time, you realize you're not where you thought you'd be, and by then it's too late to just hop off without taking a hit. The scariest part is that most people holding these bonds aren't speculators or gamblers. They're retirees, pension funds, institutions, people who genuinely believe they're playing it smart and protecting their future. But the system they're trusting has different incentives now, and those incentives don't prioritize preserving your purchasing power. If history has taught anything, it's this. When the rules of the system change, the assets that once felt untouchable become the exact ones that carry hidden risk. And right now, long-duration bonds are starting to look less like a safe haven and more like a slow-motion trap. Now here's where it starts getting personal, because the second asset isn't some abstract investment most people don't understand. It's pensions and fixed annuities, the stuff people literally build their retirement dreams on. Most people think their pension is like a locked vault with their money sitting safely inside, just growing over time. But the reality is way more complicated, and honestly, a little uncomfortable once you see it clearly. Your pension fund isn't just sitting on cash, it's heavily invested, and a massive chunk of it is parked in government bonds. Not because fund managers love those returns, but because regulations basically force them to hold safe assets like US Treasuries. So without realizing it, your retirement money is tied directly to the same system we just talked about, the one quietly eroding value over time. That means if bonds are losing purchasing power, your pension is feeling that hit too, just in a slower, less obvious way. On paper, everything still looks fine. Statements show steady growth, projections look solid, and nothing seems broken. But underneath that surface, the real value of what you'll be able to buy with that money is slowly shrinking. We've seen this movie before, and it never ends the way people expect. Argentina is a perfect example, where pensions kept paying out exactly as promised, right on schedule, no delays, no missed checks. But inflation kept rising, and over time, those payments became almost meaningless in terms of actual living standards. That's the trap. It's not about whether you get paid, it's about what that payment can actually do for you. A comfortable retirement can quietly turn into just getting by, without any dramatic collapse or warning sign. And because it happens gradually, most people don't react until it's already too late to adjust. Now let's talk about fixed annuities, because these are sold as the ultimate peace of mind product. You hand over a lump sum, and in return, you get a fixed monthly payment for life, which sounds solid, especially if you're trying to avoid risk. But that word fixed is exactly where the problem is hiding. Because while your payment stays the same, the world around it doesn't. Prices go up, inflation does its thing, and over time that same monthly check buys less and less. What felt like security at 65 can feel tight, even stressful, by the time you hit your late 70s or 80s. And unlike stocks or even bonds, you can't just exit an annuity easily. You're locked in, committed to that fixed stream, no matter what happens to the value of the currency. So if inflation runs higher than expected, you're basically stuck watching your purchasing power fade in real time. This is where it gets almost philosophical, because the system doesn't look broken from the outside. The numbers stay the same, the payments keep coming, everything appears stable, but stability in numbers doesn't mean stability in real life, and that's the difference most people miss. It's the same trick that's been used throughout history, just in different forms. In ancient times, coins looked the same, but had less precious metal inside. Today, your bank balance looks fine, your pension statement looks fine, but what that money actually represents is changing quietly in the background. And that brings us to the third asset, cash, especially in savings accounts that everyone suddenly feels good about again. Banks are offering 4%, 5%, even higher, and after years of earning basically nothing, people feel like they're finally winning. But when you zoom out and look at the real numbers, it's not as sweet as it seems. If inflation is running close to or above those interest rates, you're not really gaining anything. In fact, after taxes, you're likely losing purchasing power even while your account balance goes up. It's one of the cleanest illusions in finance. You feel richer, but your money is actually doing less for you. And there's another layer people don't like thinking about. Your bank deposit isn't just sitting there untouched. It's being used, invested, and exposed to the financial system in ways you don't directly control, which means your safe money is still part of a bigger machine that can hit turbulence fast. We got a glimpse of that with bank failures happening in days, not months or years. Confidence is everything in the banking system, and once that confidence cracks, things can move crazy fast. Most of the time, things hold together. But the point is, it's not as bulletproof as people assume. So when you combine slow inflation with system-level risk, cash stops being the safe haven people think it is. It's not about panic or pulling everything out. It's about understanding that holding large amounts long-term comes with a cost most people underestimate, And that cost doesn't show up as a loss on your screen, it shows up in your lifestyle over time. Now we get into the fourth asset, and this one needs nuance because not all stocks are the problem. Some are actually solid in messy times. The real risk sits in a specific number of companies, especially domestic-only US tech firms that don't own real assets and rely heavily on future projections. These are businesses priced not on what they have today, but on what people believe they'll earn years down the line, and that belief depends a lot on the strength of the dollar. When money was cheap and interest rates were near zero, those future earnings looked insanely valuable. Investors were discounting profits 10, 20, even 30 years out at super low rates, which pumped valuations sky high. But once rates rise and inflation sticks around, those same future dollars aren't worth nearly as much in today's terms. So even if the company keeps growing, the real value of those earnings can shrink. It's like chasing a moving target where the finish line keeps getting pushed back by inflation. And if most of that revenue is coming from inside one country, in one currency, you're basically tied to whatever happens to that currency. Compare that to companies with global exposure or real assets. They've got options. They can earn in multiple currencies, adjust pricing, or rely on physical goods that hold intrinsic value. But asset-light, domestic-focused tech companies don't have that cushion, which makes them way more sensitive to a dollar shift. History backs this up again and again, even if the names and timelines change. When currencies weaken, businesses tied purely to that currency tend to struggle in real terms, even if their numbers look fine on paper. The more abstract the business model, the more exposed it usually is when the monetary environment changes. Now let's talk about the fifth asset, and this one hits close to home for a lot of people: real estate. Not all real estate is risky. That's important to understand, because land and property have held value for centuries. But the danger zone is very specific: highly leveraged residential property bought at peak prices in expensive markets. Over the last few years, property prices in many US cities went crazy, jumping 40% to 80% in a short time. A lot of buyers jumped in with small down payments, assuming prices would keep rising and rates would stay manageable. That assumption worked in the old environment, but it gets shaky fast in a new one. If inflation stays elevated and interest rates remain high, affordability drops hard. Fewer people can qualify for big mortgages, which shrinks the buyer pool. And when demand weakens while supply stays the same, prices don't have the same upward pressure anymore. Now add another layer: global demand. For years, foreign capital flowed into US real estate, helping push prices higher. But if the dollar weakens or global dynamics shift, that demand can slow down or even reverse, removing another support from the market. The tricky part is real estate doesn't crash overnight like stocks can. It moves slower, which can make it feel stable even when it's not. But if you're holding a property with a high mortgage at a high interest rate, the monthly cost alone can become a heavy burden over time. And if prices stagnate or drop in real terms, you're stuck holding an expensive asset that's not really building wealth. You can't just click a button and sell it like a stock, so you're exposed to long cycles. That's where people get trapped, not broke on paper, but financially stuck in reality. We've seen this play out before in different countries, just with different names and timelines. Japan's real estate boom in the late 80s looked unstoppable until it wasn't, and the aftermath dragged on for decades. People who bought at the top spent years just trying to break even. When you step back and look at all 5 assets together, a pattern starts to show. None of them are bad on their own. They were actually perfect for a specific era. The problem is that era is changing, and the rules that made these assets safe are shifting quietly in the background. That's the part most people miss, because nothing feels broken right now. Paychecks still come in, markets still move, everything looks normal on the surface. But under the hood, the assumptions holding everything together are being rewritten in real time. And history is brutally consistent on this point. People don't usually lose because they're careless. They lose because they keep following old rules in a new system. They stay disciplined, they do everything right, but the definition of right has already changed. So the real takeaway isn't panic selling everything, or trying to time some dramatic collapse. It's understanding where the hidden risks are and not being overexposed to them. Because in every major shift, wealth doesn't just disappear, it moves from people who don't see the change coming to those who do. And the question that started this whole thing still stands. If the dollar slowly loses value over time, which assets take the hit first while everyone thinks they're safe? Now you've got the full picture, not just what's happening, but why it matters. What you do with that information next, that's where the real game begins.